Hi everyone, my name is Kaustubh Kale. So how can you make a 20% return every year through stock markets? Let's try and understand this. So the first thing is, can we do it through stocks? Stocks will give you returns over the long term on a compounded annual growth rate basis and not every year, because when you buy stocks, you can do it only on delivery, which means you can only buy them if you think it will go up. But in case if the market sentiment does not support or the stocks goes down, you will not be able to make money out of it unless you do derivatives. Yes, so if you want to make 20% returns every year, you have to prefer derivatives over stocks, because derivatives can give you those linear predictable returns versus stocks. Stocks is only long only delivery based. You can also do derivatives in stocks, but if you are looking at stocks from a delivery based cash basis पे मैं खरीदूंगा and every year 20% करूंगा, so that won't be possible. So we will have to look at it from a derivatives perspective. Now, why derivatives? Derivatives are futures and options instruments available. They help you to also make money in case the stock goes down or in case if the index goes down, because you are also allowed to short it, which you are also allowed to sell it even if you are not holding. So derivatives are beneficial or preferred to make returns every year in a linear and predictable fashion, because they allow you to take both positions, whether long as well as short. So what are my recommendations to you? My recommendations are: use a positional strategy which is over say couple of days or 10-15 days or even a month instead of doing intraday. The next is prefer index, which is Nifty or Bank Nifty over stock derivatives, because these are most traded and most liquid, and most institutions also trade either in Nifty or Bank Nifty. The next is always hedge your position. Now, what do I mean by hedge? If you are buying futures, then buy put options as a hedge. If you are selling futures, then buy call options as a hedge. So hedging is important so that your losses are not unlimited and they are limited in nature. That is why target only 20% returns, which are possible over a linear and predictable fashion by hedging your portfolio, by hedging your trades. The next is, like I said, I prefer futures over options. So do futures and use options as a hedging instrument along with it. So money management is a very important portion here, where just like hedging was a part of money management, extra keeping extra cash as cushion is also money management. For example, if Nifty futures plus options requires your money of 60,000 per lot, then keep at least 1,20,000, which is double of it, as an idle cash available for trade to trade one lot of Nifty. This will ensure that even if your trades in the beginning runs into losses, you still have cash available to recover the money later on. Decide entry rules and exit rules depending on technical analysis. Keep a stop loss and trailing stop loss in place to limit your losses and also to book profits. So what all things are important here is do derivatives, prefer Nifty or Bank Nifty over stock options and stock futures. I personally prefer Nifty. Don't do direct stocks on delivery basis or cash basis, because you will not be able to short them. And when for making all these trading positions, use entry rules, exit rules, money management, hedge your position, keep cash as cushion, and you will be able to do well. Thank you so much, everyone. I hope you found this useful as well as interesting.